Hello. Welcome back, everyone, to Alpha Beta Soup. I'm TXMC. Well, it's been a tumultuous week. We will unpack the FOMC from yesterday, the announcements from the Federal Reserve. We'll look at some of the comments from the press conference, and we'll spend time unpacking some economic data related to what the Fed was talking about yesterday. We'll also peek in on the Bitcoin price chart, as we always do. We'll look at equities, and we'll try to talk about where we think the economy is going. If you enjoy this content, please give this video a thumbs up and subscribe to the channel. Share it with your friends. I really appreciate all of your support, and we've got so much to talk about, so let's just get right into it. So after we spoke on Monday, when the market was collapsing on itself, a couple of stories have developed in the crypto space specifically. One related to the meltdown of Celsius, and another one to the possible insolvency of the Three Arrows Capital hedge fund. Both of those have had major implications for price action, and there's a lot of rumor going around on CT. Since both of those stories are still developing, I don't really want to spend time unpacking them here today. But just know that as we've continued to unwind in price, each level down has revealed new fragility in the market. There's so much leverage and interwoven exposure between institutions, between individual assets in markets, that every time we move down to another leg, there's some weakness that gets revealed, someone who's over leveraged, who's out of position, and is having to manage their losses. And it's because we built a house of cards for 2 years with record liquidity, and no one really bothered to check the weather forecast. But here we are, and the wind is picking up, and what do you know? But most of this stuff we're standing on top of is built on nothing. It's built on air. People are over leveraged, they're overexposed, assets are inflated beyond their reasonable values, and as a result, the fall is swift. The liquidity to support prices is simply not there. So downward price action has a way of leaping through the void, and before you know it, we find ourselves at historical lows. And where we are with Bitcoin right now is extremely close to the 2017 all-time high. We're just a couple of $1,000s away from it right now. On my screen, I have it around 19,900, and as of this moment, Bitcoin price is at 21,100. It's been dancing around the 20,000 mark for the last couple of days. It's tried to dip below it, but we haven't actually properly broken 20K yet. Though the way it's looking this morning, maybe we get that test sooner or later. When we look at equities, the Dow Jones dipped below 30,000 here in the first half hour of the market being open. It seems like momentum is still solidly to the downside here. So I do anticipate at some point that we will break below 20,000. It's just hard to fathom a fall of this magnitude and pace all the way down to such a significant level, but to never actually go below it. That just isn't really the way markets work. It makes sense that at some point the market would test the liquidity below here, really see what it's made of, see how badly holders want to defend that level. And I think it's healthy, honestly, guys, because when you look at Bitcoin's history, there is a lot of dogmatic belief. People believe that there's never a point where Bitcoin will break below the previous cycle high. And there's people who bank their investing theses on these kinds of absurd myths, for which there is no actual tangible truth to tether to it. There's no reason why price cannot go below the previous all-time high. None at all. And I think that shattering these kind of myths, dancing down below here, is only a healthy thing for the asset moving forward. That we break these completely illogical beliefs people have about how price is going to behave. That if you hold Bitcoin for 4 years, you're guaranteed to be in profit. That if you hold through a bull market, you're never going to go back below the previous all-time high. These kinds of things are just ripe for the taking. And when we're in a bear market like this, these are the opportunities that you see these myths broken. So I do think at some point we will go below this level, just based on the way price action is. Perhaps I end up being wrong. I'm not trying to predict an outcome here, but we've fallen all the way down to this level, and there hasn't really been a sign of a true capitulation bottom here. The volatility is still relatively low. We haven't seen a blowout on the VIX in equities either. The volatility there has been relatively low. So my base case is that it isn't likely that we escape from this region without a little bit of scarring, that we don't come down here and find out what sits just below this level. But what I want to spend time talking about today is the announcement from the Federal Reserve yesterday. They raised the terminal rate by 75 basis points, which is higher than they had originally said they wanted to raise it. But from Monday until the announcement came out yesterday, there seems to be a notable shift in the expectations of market participants. JP Morgan, Goldman Sachs, and several others announced on Monday and Tuesday that they expected the Fed to raise by 75, not 50 as they had planned before. It really felt like some news had come out secretly from last week's inflation print until this week, where market players were given some kind of hint that the Fed would raise 75 basis points, probably in direct response to the higher inflation print we got last week, which surprised a lot of people. And in an effort to regain control of the inflation narrative, the Fed felt it necessary to come out and raise 75 basis points, which is the highest single hike they've pulled since the 90s. And there were some interesting developments in the announcement yesterday during the FOMC. One of the things that caught my eye was on the press release, which they put out about half an hour before the press conference itself. And in the very first sentence of the press release, they say, overall economic activity appears to have picked up after edging down in the first quarter. Now, this was a bit puzzling to me because when you look across the data, there's a lot suggesting that growth has slowed, not that it has picked up. But I think that they're playing a little bit of word games here. So in the first quarter, we got minus 1.4% GDP growth. It surprised everyone to the downside in a major way. And what they may be saying here is that GDP growth in the second quarter is not as bad as negative 1.4%, which is a relative improvement. And it allows them to say things like activity appears to have picked up. But maybe we get a negative 0.8% GDP print, which is relatively better, but still lacking in growth. And this is where it gets into the wordplay mechanics of the Federal Reserve, their massaging of sentiment from the pulpit. And it's one of their most powerful tools. It's the one they've used the most effectively this year, when they've really done very little tightening at all, but the markets have reacted swiftly and strongly to expectations that they would. So the Fed thinks that economic activity has picked up. So why don't we look at a little bit of that stuff? Well, the first thing we can really look at is their own estimates of GDP. So this comes from the Atlanta Fed. They have a tool called GDPNow, and every day it updates their estimates on where they think GDP will be for the given quarter. Now, the green line here is the Federal Reserve's own estimates. And you can see here back in late April and mid-May, they still expected around a 2% GDP growth. You know, it kind of was chopping around. But since May, since the middle of the month, it's been declining steadily. And just the most recent update, they took their projection down from 0.9% around June 8th, which is where it was back here. It was at 0.7 most recently, and it fell all the way to 0%. So they have been adjusting their growth projections down for over a month now, and they have now gotten all the way to 0, while they're still telling us that economic activity has picked up, and they don't believe that we're going to have a recession. But they were surprised to the downside by a full percentage point in Q1, and we're looking at their estimates now for the current quarter, which ends at the end of June, and their estimations have been falling week over week, now down to 0%, and there's a very real likelihood that they will be wrong again, as they have been wrong before. Something else they mention up here, second quarter real gross domestic investment growth fell from negative 8.5% to negative 9.2% this quarter. That is capital expenditure in growth, right? Building out infrastructure, building out machinery, investing in your product. That growth is down. It was already minus 8.5%. It's down to minus 9.2%. We're seeing a major slowdown in domestic investment in business, while we're also seeing their total estimates for GDP getting reduced week on week, now down to 0%. What will the next projection be? Will it be negative? We'll have to wait and find out. And, you know, some of the details that they released in the FOMC yesterday have me a little puzzled. This is a look at their summary of economic projections. This is when they survey the group and they all decide where they think certain indicators are going to be at the end of the next few years. And what they're projecting here, this is the unemployment rate, the median unemployment rate that the group projects to happen. So at the end of 2022, they expect unemployment to be at 3.7. It's currently at 3.6%, which is historically low. They think that by the end of next year, employment will have risen to 3.9%. And by the end of 2024, it will have risen to 4.1%. Now, 4.1% is still an historically low unemployment rate, but from where we are now, it's about a 10% jump. When you see where their projections were from March, they thought unemployment would stay relatively flat, and now they have conceded that it is likely to rise. Now, one thing about this that jumps out to me is that it's very difficult to project continually rising unemployment for the next 2 years, but to also say that you don't expect there to be a recession. Because when you look back through history at the unemployment rate, seen up here at the top, when it begins to rise, we're usually entering a recession. It's extremely uncommon for unemployment to simply start rising and drifting higher without a recession being on the menu. Look at every time, going back to the late 1970s, when employment is rising, it's because of a recession. That's what these gray bars in the background mean. Here we are, sitting down here at 3.6% unemployment, which you can see is historically very low. And they are telling us that they think that over the next 2 years, unemployment is only going to rise just a little above this dotted line right here. And that during that magical 2-year period, we will not experience a recession. I find that extremely hard to believe, and I find these projections incredibly strained. Additionally, they also point to personal consumption expenditure inflation, which they estimate to be around 5.2% by the end of the year. And then by the end of next year, they expect it to get chopped in half. Now, this is something that has consistently been in most of their projections. They expect inflation to simply fall away. Now, we know that a lot of what's going on with inflation is supply side driven. It's because of shutdowns in China. It's because of actual structural constraints to commodity production, particularly oil, because of the war in Ukraine between two of the world's largest exporters and all of the knock-on effects and the sanctions and all of those things that have come out of that. All of those are playing on inflation. And it's true that if any number of those factors begin to improve, perhaps inflation rates will begin to cool rather quickly. But there's also a chance that that doesn't happen. If China continues with this zero COVID policy, which is almost unmanageable and unrealistic, they're going to continue to shut down every time they reopen and see a single case, which has happened every time. Additionally, some of these problems, some of these backlogs are not going to simply go away when China decides to reopen. It's going to take months to get supply chains up and running, flowing again, for retailers to get the orders that they're looking for inventories to be cleared out, for warehouses to start taking in new inventory when they're already strapped for space. There's a lot of things that kind of have to unfold, and it really seems like a lot of the projections coming out of the Fed hinge upon this belief that inflation is simply going to get chopped in half at some point in the near future because of factors outside of US control. That's banking on a lot. Perhaps it plays out that way, but I bring it up simply to highlight the fragility of their projections, that it relies on things going well, things working out for them, in order for all of these numbers to coalesce into something realistic. But even more than this PCE inflation thing, really seeing rising unemployment for a 2-year period and not expecting us to incur a recession is not realistic. And thinking that unemployment is only going to rise 0.4% over a 2-year period, those things just don't really add up when you think about the current climate, when you think about where debt levels are, the amount of strain that businesses are under, and the very real likelihood that a bunch of people could lose their jobs in the next couple of months. Those things just do not vibe with their projections. Now, why do I keep saying that people are going to lose their jobs? Well, we're seeing more and more announcements of layoffs. So this website is layoffs.fyi. They do a good job of sourcing layoff announcements. They have a big table here. They source them all with links. They count how many people are being laid off, and then they chart it. They've been doing this since COVID. And what you can see over here on the right side, these blue bars represent layoff events. The red bars represent the number of people being laid off. Now, what jumps out to me here here the spike in these blue bars the last 2 months. So after having really a 2-year period of very low layoff events following the wave from COVID, in the month of May, we saw a quick spike of 74 new layoff events announced, and they totaled about 17,000 people according to these sources. Now, some of these businesses don't always give a total number for how many people are going to get laid off, so the number of people is a little bit of an estimate. I like to look at the number of events, and we see a big spike here, down from where it was only around 24 in April, which itself was an increase. We've now seen like a 5-month increase in these layoff events. Well, the entire month of May, we had 74 of them. Today, on June 16th, we are only halfway through the month of June, and there are already 71 events. Only 3 shy of the entirety of last month. So layoff announcements are accelerating. Now, we've explored on this channel quite a bit the risks to the labor market. We've explored how Target and Walmart have complained about being overstaffed, how they have complained about having too much inventory, how Target is probably going to undergo flash sales to try to clear some of that inventory. And if those things don't work out, if those companies are not able to manage their margin pressures, or if their input costs don't come back down, those companies will be forced with the very tough decision to probably begin laying people off, to begin cutting staff, cutting hours, freezing hiring, all the things that we're seeing coming out of big tech and crypto. BlockFi announced layoffs, Coinbase announced layoffs. It's happening. And I think the real risk over the next couple of months is that this balloons out of control. No one wants to be the first company to announce layoffs, but as soon as one does, you really start seeing the dominoes fall. And in the last 2 months, it has accelerated quickly. So when I hear the Fed talking about how unemployment is going to stay relatively controlled, they don't think it's going to lead to a recession, I just don't think that they're vibing with the actual data that we're seeing. And in part, they need some people to lose their jobs. Anyone who's been watching us unpack this economic data for the last few months, we've talked about how the Fed likely needs to cause higher unemployment. It's a place where they see tightness and that they can create some slack. They believe that they can tighten financial conditions without reducing the amount of available work for people seeking work. But as we've explored, the amount of people seeking work is less than it's ever been before. And that doesn't mean that those people don't need income. It just means that they're not seeking employment through the traditional means that we use and we aggregate with our metrics. Look at the labor force participation rate. These are the amount of people in the workforce of working age who are actively participating, right? And it has been dramatically declining since the year 2000. It fell off a cliff in COVID, and it hasn't even gotten back to 2015 levels. It's still considerably lower than it was before. And it's because a lot of people left the workforce and they haven't returned to traditional employment. Some of those people may not need jobs. A lot of them became retirees in 2020. We saw a wave of people retiring early. Some of those people have modified their living situations. They've moved back in with their families. They're living in multi-family households to try to save money. There's a lot of people adapting from where they were a few years ago. And in some ways, the data and the way that we track those things hasn't caught up to those new waves. And so when you see labor participation being all the way down here, there's a lot of reasons for that. But it also goes to really emphasize why the Fed staring at top-line unemployment can be very misleading. Because if you don't seek a job, if you're not actively looking for employment within a window of time of when they run this data, you are not in the labor force. You are considered out of the labor force. And those people are not part of this unemployment number, but they make up a considerable percentage of the working age population of eligible labor should they choose to become that. So I bring up all of this stuff because there's a lot of nuance in this data, and it's important to me that we explore it, that we talk about it, but we be aware of the flaws in the approach to some of this data. And there was a moment in the press conference yesterday that I want to play for you that really kind of shows how the Fed is thinking about unemployment. And it's not just me trying to drum up scare tactics to point out that they're looking to cause job loss. I'm not making that up. So this is a moment from the press conference yesterday, and I'm going to play it for you now.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. So the new projections show the unemployment rate ticking up through 2024. Is a higher unemployment rate necessary in order to combat inflation? And what is lost if the unemployment rate has to go up and people lose their jobs in order to control inflation? Thank you.
So
How long he pauses.
you're right. In the SEP, we have unemployment going up to 4 point. The median is 4.1%. There are, of course, a range of actual forecasts, and I would characterize that if you were to get inflation down to, on its way down to 2%, and the unemployment rate went up to 4.1%, that's still a historically low level. We hadn't seen unemployment rates below 4% until a couple of years ago. We'd seen it for like 1 year in the last 50. So the idea that 3.6% is historically low in the last century. So a 4.1% unemployment rate with inflation well on its way to 2%, I think that would be I think that would be a successful outcome.
So he just said that unemployment is historically low, and that even if it goes up to 4.1 or 4.2%, that is still historically low. This last part he's about to say here, this is the kicker.
So we're not looking to have a higher unemployment rate, but I would say that I would certainly look at that as a successful outcome.
We are not looking to have a higher unemployment rate, but I would certainly look at that as a successful outcome. He's literally saying the quiet part out loud here. But this part got missed in the news yesterday. Everyone was talking about the rate hikes, talking about what he thought for future hikes, etc., the actual material pieces of the announcement. But the way he answered this question is very telling, because it comes back to this chart that we were just looking at of unemployment. They see it all the way down here at historical lows, and they think that they have room to continue tightening without putting us into a historically bad place. They think unemployment could rise a whole 0.5 percentage point up to 4.1%, and that wouldn't cause a recession and it wouldn't be a disaster. But every time in the past that unemployment has risen by a 0.5 percentage point or more in a year, we have had a recession. And when you look at the labor participation rate, it is lower than it has ever been, not counting the recovery from COVID itself. It's still in this lower bound, and it's because there are a lot of people out of work that are not being counted by the system. And when we go look at layoffs.fyi at this website we just talked about, you can see the increase in layoff announcements. They are coming. And unfortunately for the Federal Reserve, they have utterly zero control over how many people lose their jobs and how quickly it happens. So they're trying to tighten. They're pointing at this very flawed top line metric, and they're thinking they've got room to continue going. But the underlying labor market is already beginning to weaken. And it's got me seriously concerned that we may see large layoffs before we get to a place where the Fed is already talking about softening their stance. And it may be too late at that point. I don't know. And one of the other things that they commonly point to is spending, right? He keeps talking about consumer spending strength being high. And I think that is partially being distorted by the inflation rate, right? When costs are going up, when prices are going up, the top line number of sales can be higher while the amount of units that you are buying with those dollars is less. Your money is not going as far as it was before. Here is a chart from Bank of America, and it's showing total nominal credit card spending versus real spending. The top is nominal credit card spending. The blue line is adjusted for inflation. What is the pattern you see? You see a divergence, right? You see rising nominal spending while real spending, inflation adjusted spending, is falling. And that is showing you that people are continuing to spend money, in some ways out of necessity. They're forced to buy some of these goods to survive, and the amount that they're taking home from it is less and less. This is the active vaporization of savings going on right here. Spending more money, getting far less for it. This pattern cannot continue for long. This is retail sales. This is from advanced retail sales, including food and services. The red line is year-over-year retail sales. The blue line is real retail sales. So retail sales adjusted for year-over-year inflation. What do you see? You see positive retail sales. It's up 8.1% year-over-year, though it is the lowest value since the beginning of 2021. Real retail sales is negative, and it has been negative since March March of 2022. This is March, April, and May that are all negative retail sales when adjusted for inflation. So we are seeing here a weakness in the consumer despite top-level spending numbers being high. What they're taking home is less than what they used to take home, but their top-line spending is the same. Here's a look at wages, much the same as retail sales. Wages, year over year, up 5.2%. But when you adjust for inflation, real wages, seen through the lens of average hourly earnings, are negative. And this value has been solidly negative since April of last year. Look at this. It's been bouncing around negative month over month over month for an entire year now. On the one hand, this is showing that we don't have a wage price spiral because wages are simply not keeping up with inflation. But it's also showing that employers are simply not able to continue rising wages to keep up with inflation. They can't continue to pay people more when their input costs are rising, right? When the money that they're spending to acquire their inventory is also going up. Their total input costs are rising and their margins are getting squeezed. And then when you see the consumer, which is still spending money but is getting less for it, these pressures are working against each other. One of the ways we can really look at how input costs are affecting retailers is comparing CPI to PPI. So CPI is Consumer Price Index. Producer Price Index is the input costs for businesses. It's the prices that they have to pay for their materials to produce their goods. And if you look at these two over time, this top line in black is comparing CPI to PPI. Now, what you can see basically since the 80s is that CPI has been outstripping PPI. It's been growing faster. What this is showing is that in large part, our bull runs since the late 1970s were aided in part by retailers being able to pass along price rises to customers faster than their input costs are rising, right? They're able to pass on those costs, apply them to the retail consumer. The consumer is eager to continue buying and everyone's making money. Everyone's happy. Well, you can see, there are periods where this pattern has reversed, but the most notable change is really here in the last year and a half, 2 years, basically since 2020. As producer prices have been skyrocketing, they have been rising even faster than inflation. And so this little bubble, this retail price passing along bubble that businesses enjoy basically since the late 70s, early 80s, it's given back about half of the breadth that it was able to gain over a 35, 40-year period just in the last 2 years because of quickly rising input costs and the inability to pass along those new prices to customers at the same pace. Down here at the bottom, this is CPI and PPI separately. CPI in blue, PPI in red. You can see the disparity here for years and just how quickly that gap has closed just in the last 2 years. So there's a lot that is changing under the surface in the US economy, and we are simply not in the same market environment that we have been in the past. That's why I think there are a lot of people in crypto that are caught off guard by what's going on. They're still trying to call bottom with every bounce, and they're going to be left at the altar. There's still a belief out there. There are still people eagerly buying the dip. Everything we're looking at in the data is showing that we are in for a period of severe consumer pain. And the reason that that is important is because the consumer drives the economy, okay? This line up here at the top is consumer spending as a percentage of gross domestic product of the entire economy, and it's at 68%. Well more than 2/3 of our entire economy is powered by the spending of consumers, the health of their finances, their willingness to buy things. Because we don't produce that much here in the US, we are rampant consumers. It's been going that way since the middle of last century. You can see this level slowly rising generation over generation. So it's very important that we pay attention to the health of the consumer. And when you see negative retail sales, you see negative wages for over a year, and you see the benefits of being able to pass along costs to healthy consumers getting chopped in half and losing 40 years of gains, it really emphasizes how different this market condition is. And I think we've got at least a few more months of trying to watch this data, seeing what unfolds, and we're really waiting to see what breaks. At this point, the Fed is going to continue marching forward until something begins to soften in the market, be be it labor, be it the bond market goes no bid like it did in 2020, maybe corporate credit completely deteriorates, which I still think is probably a few months away. Who knows what it is? But the Fed thinks that they've got room to tighten because we have low unemployment. And the narrow lens through which they view the economy and the way that they relate it to their goals, I think sets us up for pain in the interim and a potentially calamitous market crash at some point in the future if they don't recognize the error of their ways. Because I believe they're making a multi-generational policy error here by tightening while we are on the doorstep of a recession. Later next week, I'm going on a long-needed vacation. So what I think we'll probably do at least one more video before I leave on my travels. And I may record 1 or 2 videos that go out while I'm gone. So you guys at least get to check in with me. We can talk about some of the other things I'm looking at. And hopefully the market doesn't explode for a week while I go get some much-needed relaxation. I hope you have an enjoyable weekend planned ahead. After a week like we just experienced, it's really important to get away from the charts, go get some fresh air, and just decompress. We'll continue to watch the Bitcoin price chart, see if maybe it dips below 20K, and we'll wait for a little more economic data to roll in. There's some other things that I'd like to unpack, some things related to demographics, etc., that we'll save for a future video because we already talked about quite a bit today. And that's where we'll leave it. So I hope you enjoyed today's video. Please leave comments down below for me if you have feedback, if you have questions. I'd be happy to engage with you. And we'll talk again in a few days. So until then, take care of yourselves, be kind to each other, friends, and we will chat very soon. Cheers.